Good morning, everybody. Welcome to this update for global stocks for the 13th of September. And we saw another week of pretty excessive volatility in the Australian market. We had two big up days after a sell-off the previous week, and then one big down day that reversed all the previous gains. Something similar in the States, but it managed to make an overall positive gain for the week. But it's times like this when we've got this sort of volatility that it's really important to step back and think clearly about what you're doing, because it's so easy just to get caught in reacting to these big market moves. So that's really what this particular edition is about. So let's have a quick look. The S&P ended up higher by 40 points on the week. But I really want to make the point that sector performance can vary enormously from one sector to another in every single market. And the Australian market's no different, the American market's no different. So don't get caught by just thinking about the index. You know, the ASX 200 or the Dow Jones or the S&P 500 is what gets reported on the news, and that's what you see. But that hides a lot of positives and it hides a lot of negatives as well. So you've got to make sure that you understand what part of the market it is that you're actually trading or investing in. So the important thing, as I've been just reiterating over and over again for several years now, is the focus on quality and value. If you want to try and play this market in a momentum kind of way that has been fairly profitable over the last year or two, from 2000, particularly from 2011 through to 2014, then that game is changing. And if you just use the same methods that you've used in the past into this kind of very volatile market, and particularly one where there are some significant changes on a sector basis, and we'll have a look at a couple of those big decliners, then you could be in for a lot of trouble. So really important to focus on quality and value. There is definitely a level of computer manipulation going on. There's algorithmic trading programs that are driving the market. I've seen estimates that up to 70% of trading on the New York Stock Exchange is not the decisions aren't being made by human beings in real time. They're just responding to what computer programs are doing on a millisecond by millisecond basis. And therefore, what we're seeing in the short term sometimes is just completely unrealistic prices in the market. All eyes will be on Thursday's Fed meeting, whether they will raise interest rates or not. Sorry, that shouldn't be a cut. Is mostly priced in. A rise is mostly priced in. Look, I don't know which way it will go, and maybe even the Fed doesn't at this stage either. But I think if there were to be a rate rise, I think it's probably mostly priced into stocks. There might be an initial downside reaction for a few days if they do raise interest rates, but I don't think it's going to change things in the medium term to any great extent. Now, I just want to make a point before I look at the S&P chart about what I was just saying on a sector basis. Now, this is the period from 2000 to 2003, which was a reasonably significant bear market. It started with the tech wreck of 2000 on the NASDAQ, which ultimately lost 80% of its value. And as you can see on the bottom line there, the bottom black line is the S&P 500 index. You can see running through the middle of the chart is basically, this is the zero line taken from a common starting point in 2000. So you can see that the tech wreck certainly dragged the S&P index down substantially, and it was down between 20 and 35% during that period. But if you look at the sectors above the line, these sectors actually went up. Consumer staples, financials, and utilities all went up. And you can see in the first part of that bear market, for the first year or so, they actually went up substantially. Consumer staples and utilities were up by between 30 and 35% at the start of a bear market. So, please bear that in mind. If by some absolute miracle we are going into some sort of bear market, and the fundamentals certainly don't support that, as I've been outlining over recent weeks, but if we were, you've still got to look at it on a sector by sector basis. There could be some sectors that still do really quite well for the next year or two. Now, also because the Fed announcement on Thursday will be so important, I just want to reiterate again, because it's going to be perhaps things you're going to read that are going to say when interest rates start to rise, then that's it, it's all over for the stock market. That is just not true. I put these charts up a few weeks back. I'll just whiz through them very quickly. This is 94, 95. The orange line is the start of the interest rate rising cycle, and the blue line is the S&P 500 index. And you can see interest rates started going up. Initially, the S&P went sideways for a year, and then it also went into a substantial rise. This is 98 to 2000. We had a little bit of a dip in the Fed funds rate, and the S&P was pretty volatile during that period, but it definitely went up. It went up from just over 1,200 points to nearly 1,500 points, a very, very substantial rise. And this was the 2004 to 2007 period, and you can see a very, very sharp rise in the fund rate. I think that will be far faster than what we're going to see this time. And yet the S&P went up almost uninterrupted during that period. So the start of the interest rate rising cycle, just really to say that that's going to be it for stocks is just not true. Now, I want to now look at the American stocks from a charting point of view, because the point I've been making repeatedly over weeks and months is that there isn't a fundamental basis for a bear market, and we've never had a bear market without a recession, and I don't think we're about to start now. However, you do need to pay attention to what the charts are telling you, and I'm always prepared to be open-minded if there is a change in character in the market. So I would like to take a look at the patterns that we're seeing. And I also just want to look at a couple of stocks just to underline that previous point I was making on a sector by sector basis, that even though the index might be going up, you can still get some substantial decliners and vice versa. So on the S&P, there is a wedge pattern that's formed now after that initial big drop a couple of weeks ago. It's still got to be resolved. The market could go either way in the short term. A new low is possible, but maybe a higher secondary low is also possible. It's really very, very difficult to say at this stage. But what I can say with a great deal of confidence is that if we do get any more sudden downside, that there is terrific buying opportunities for selected stocks in selected sectors. In fact, those buying opportunities exist already. There's really some outrageous bargains, but they might just get a little bit cheaper yet based on emotion. So let's take a look at some charts, and let's start initially just with just want to make the point about some stocks that can go down because the sectors are out of favour. Now this is one of America's larger casino operators, Wynn Resorts. And we're looking at a period here from mid-2012. You can see that the price really spiked up very hard, got to about $250. Then it started to back off. And in hindsight, the things that are going on in China were starting to have an impact, and we saw the price start to fall away, and we broke these lows here. The October 2014 lows, we broke through there, went sideways for quite a few months. It was still trading at $190, and now you can see it's at 65, so it's lost 2/3 of its value. And you can see that there is quite a change in character. The moving average has rolled over. The price is now spending almost all its time below the moving average rather than above it. It's a pretty simple thing for anyone to determine. You've just got to step back and look dispassionately at what's going on. So that was a major, major decline. We look at Caterpillar, which is the world's biggest equipment manufacturer for the mining industry. No surprise at all to see Caterpillar fall away from around $100, and it's now trading down at 72. So one of the world's big industrial companies has lost 1/3 of its value. And let's look at ExxonMobil, the world's biggest energy company. So energy has been very much out of favor. So these are all in substantial bear markets. So ExxonMobil down from $100 down to 70. So there are bear markets, and we're already in bear markets in certain sectors. It's just we're not in a bear market in the S&P 500 yet. So let's look at the S&P. This is the daily chart, but I want to step back and look at the monthly chart first, just to get a bit of a bigger sighter on it. So you can see we've certainly had a bit of a dip, but look, that dip is no worse. This is August and then September in 2011. So what we've got at this point in time is no worse than what we had back then. Now, it's possible that it could develop into something more substantial, but it would certainly defy the fundamentals. So it bears watching, but at the moment, we don't have a changing character of the market. Let's look at the S&P. So you can see here, the moving average is just starting to roll over. Yes, we're down underneath it, and I'd want to see the S&P regain back above that 150-day moving average within the next month or two. If this wasn't trading back above the moving average by the time we get into late October, then I would be getting a little bit concerned about, certainly about the index anyway. But at the moment, we've had this initial substantial downdraft. We've now got a wedge pattern forming up here. We don't really know how that's going to resolve at the moment. It's looking more like it's a wedge pattern that's pointing a bit more to the upside. Sorry, just let me grab a hold of that. So at the moment, I would have to say that the odds slightly favour a move back to the upside, but I wouldn't rule out a move to the downside either in the very, very short term. So for me, the jury is still out on that index. Now let's just quickly look at the other indices as well. This is the NASDAQ index. So you can see that it's been an enormously strong trend. Yes, we've had a sharp dip. Yes, this could be the start of a change in character, but it's not determined yet. Moving average hasn't rolled over. The price has dipped under it, but you've got to give it a month or two to see if it can regain. So the NASDAQ is still okay. Let's look at the Russell 2000 index. Sorry, let's get the right chart. There's the Russell 2000. In fact, let me go back to the actual index itself. That's probably a better one. So you can see the Russell 2000, which is the small caps, and now supposedly the breadth of the market is falling apart. So many stocks are in bear markets. Yet the Russell 2000, which doesn't contain the big market leading stocks. These are the smaller stocks, and you've got to say that there's a little bit of a dip, but really the character hasn't changed over the last 12 months. So the jury is still out on these indices as to whether anything has really changed. Let's have a look at the volatility index, because that's important as well. We get this periodic spike in volatility. This is 2011. You can see it's a very substantial spike. Let's go back a bit further. There's 2008. That was the GFC. The VIX index got up to 100 very briefly, but spent most of its time around the 50 to 70 range. And obviously that was unbelievably extreme volatility. This is 2010 when we had a flash crash. The volatility index got up into the mid 40s. 2011, when things really were ugly, people were talking about the euro collapsing because of Greece, and the VIX got up to the 50s. This time we've peaked at 38, and we'll just have to wait and see a few more weeks to see how the VIX settles down. But at this stage, it's nothing more than just a normal spike up in the VIX that happens from time to time. Now, while I'm here, let's have a look at the Australian market. We'll start with the Australian dollar initially, and you can see that we remain in quite strong downtrend. I put a chart up a few weeks ago, a long-term chart that showed the support of the Australian dollar, a long-term incline support getting broken, and you can see that we continue to head down, and we're considerably underneath that moving average. So no change for the Australian dollar. We've had a bit of a rally back up from oversold. You can see we were quite oversold. So the rally back to 71 is pretty normal, but I wouldn't expect it to go too much further. Now let's look at the Australian market. So this is the ASX 200 index, but look, we could equally just look at the banking index. So if you look at the last week, we've had two big up days, one big down day, and then Friday was a bit undecided. If you look at the banks, the pattern is virtually identical. So there's really no point in looking at the ASX 200 or taking any real clues or conclusions from it. You may as well just look at the banking index, because that's about 40% of our market. So to my mind, pretty much a waste of time making decisions by what's happening to the ASX 200. Yet, it's so interesting that that's all the media wants to tell you about on the news. They just report the ASX 200 and think that that's some piece of valuable information. So Aussie stocks, we've broken 70. We've rallied back to it, but I still think low to mid 60s is the likely outcome. The index, just for the record, was up 31 points for the week, but it's really just about whether the banks are being supported or sold off, and that's pretty much all that's driving the Australian market. Looking at commodities, gold declined another $16 for the week, and there are some gold bulls emerging again. They seem to come out of the woodwork every 3 to 6 months and tell you that we're about to go into a major bull market. and look, I think eventually we will. But I'm going to wait until the charts actually show me that it's happening. And at this point in time, stocks are still not responding. So let's take a look at, first of all, the gold chart. Let's just look at it on a weekly basis. So you can see we just continue to track around this 1100 to 1150 area. But as you know, I've made the point very many times that gold stocks will lead in both directions, up or down. And at this point in time, gold stocks remain firmly in downtrend. Could be forming a base, but wait until it happens before you'd be tempted to do anything with gold stocks. Looking at commodities, copper was up a bit, but I think that was more currency related. The US dollar was a bit lower. Crude oil steady at 45. And again, there are people coming out saying we've seen the lows in oil, but I think that's a very brave call at this stage. And there's the spot copper chart, has blipped a little bit, but that's not unusual. So just to wrap it up, the overall strategic approach, you have to pay attention to fundamentals and value, because money does have to go somewhere. It's not just going to disappear off the face of the planet. Money has to find a home somewhere. So fundamentals, economic fundamentals, and value fundamentals still matter. So money will look for a home, and it will go where the return for the risk is perceived to be the best. And in some sectors of the American market, the potential return relative to the downside risk is extremely attractive. And members know what sectors and what stocks I'm talking about. In other sectors of the market, then things are not the same. There are some substantial risks. But ultimately, the stock market will always find support for good stocks. But always be aware of a change in the character of the price pattern. We are at a bit of an indecision point at the moment. You've got to be open-minded and prepared to acknowledge that there is a change in character and take action if required. So that's it for this week. Anyone who's not a member of Special Share Education would like to communicate with me, there's my email address, and we'll see what the all-important Fed meeting brings on Thursday night. That's it for this week. Cheers.